We're pleased to be joined on Trading Nation by Rebecca Patterson, Chief Investment Officer of Bessemer Trust. Rebecca, inflation and interest rates, the double I story, I think, is really the market story so far this year. What's your take on inflation and rates and what it's going to mean for our viewers' money?
So, Brian, great to be with you. I think inflation is definitely a newfound theme this year after last year it continuing to disappoint. Very low inflation for a prolonged period. It's come back a bit. And we are seeing that reflected in interest rates. 10-year yields going above 2.9% now. It's partly on inflation expectations and inflation. It's partly on growth expectations with all this fiscal stimulus. And maybe in a slightly darker corner of the world, it's partly worries over bond supply pushing up yields because of all that stimulus.
Yeah, and do you think that a 3% yield, assuming we get there, we're doggone close, is going to derail the stock market rally entirely?
No, not necessarily. I think if yields rise gradually, and I think, Brian, you and I have discussed before, a lot of this has to do with the pace of change, not necessarily the absolute level. If we get a gradual move in yields and it's supported by strong economic growth, then I think you can have rising yields and rising equity values. And that's what we're seeing today, certainly. I think the worry would be if we had more signs of economic weakness at the same time we have inflation, that scary stagflationary environment. Higher yields then go with lower equities. I don't think we're getting that. I mean, I know retail sales today were a little softer than expected, but with wages rising, the job market strong, I think the consumer's in good shape, and this was just one data point.
Yeah, and retail sales were actually up 3.9% year over year. The headline was down. Sporting goods was terrible. A couple other things. It wasn't the awful number that maybe the headline might have suggested. But do you think the Fed will at some point ride to the rescue again? The last 10 years, Rebecca, every time there's been a wobble in the market or the economy, we've had this sort of underlying sense the Fed is there to, cradle us, Is now you think the Fed is over that and that Jay Powell, the new Fed chief, is going to say, you know what, the market, you're on your own, and we're going to raise rates no matter what happens to the equity market?
I think the Fed is probably relieved to see a little volatility in equities. I think it was a big focus for a lot of Fed officials last year. The very low volatility environment, the straight line up for stocks, frankly, made them uneasy. So today feels more like a normal environment, a drawdown of 10, 11% in equities. That's typical for a given year, even when equities end up. So I don't think they're coming to the rescue today. I think if we were to see equities continue to decline for a sustained period and that start to get reflected in economic data, we'd have a different situation. At this point, I feel strongly, and the market agrees, that we're going to get a March rate hike from Chairman Powell and team. And at this point, we now have, I believe, 3 hikes discounted in market valuations for the rest of this year. And the equity market so far doesn't seem to mind. Do
you think that corporate earnings in the economy is strong enough to mitigate any negative impact of higher rates on consumers or valuations?
Yeah, again, if interest rates are rising alongside stronger growth, I think we're fine. However, one thing that I've been writing about and watching for the last 6-9 months is the corporate debt situation. Outside of financials, we're back to levels of leverage in the U.S. corporate sector that we haven't seen since 2007, 2008. So understandably, companies took advantage of quantitative easing and low interest rates to borrow. But now we're at a point in time where 10% of U.S. companies cannot even meet interest coverage with current revenues. 10% already, and that's before the Fed hikes further. So if the Fed were to get aggressive and hike quickly and we didn't have strong growth with that, I think the corporate sector would be very vulnerable, particularly in certain parts of the economy like retail and some energy companies.
So you're watching default rates too?
Well, default rates tend to be very backward-looking. When we have the crisis, default rates won't tell us it's coming. They'll tell us it came. So I think for me, it's really understanding, is Jerome Powell and team going to try to get ahead of the inflation curve, or are they going to let the economy run hot? My base case would be they let it run hot, only because central bank chiefs in every country in the world, if they have to make a mistake, create a bubble or create a recession, I think they take the bubble. If you have a recession and that's your legacy, it doesn't sit well with you. So if we raise rates gradually, maybe we have a bit more inflation. As long as growth is there, I think stocks do fine and the credit markets can be okay. If Jerome Powell decides he needs to get hawkish, inflation is getting away from him, I think our first sign of trouble that leads us to the end of this bull cycle, we'll probably see that first in the credit market.
Well said. Rebecca Patterson, Bessemer Trust. Rebecca, don't be a stranger. Love having your views on Trading Nation. Thank you very much.
Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.